Good day, fellow value investors. The Fed has cut rates, stopped quantitative tightening, going to quantitative easing, and the key here is that inflation will be higher going forward. The solution for your wealth there is bottom-up value investing. So, cuts, no matter what will happen next, they have already been lowering interest rates, plus they will not tighten the balance sheet anymore, they will start perhaps likely even to print money again, and despite the fact that inflation is not at 2% as the target is, but at 3%, which tells me that inflation at 3% is likely the future, perhaps even higher. And job gains have slowed, risks to employment rose in the last months, so the economy is not doing that well. Jobs are more important than price stability, according to the Fed. And that's what I want to discuss. What's going on? The stock market is up because rates are going down, everybody is partying, and the party is not ending. But the only solution for us, value investors, because the party one day will end, to be ready there is bottom-up value investing for protection while still making some money. Let's discuss the Fed's recent actions. Lowering rates, starting to print money in the future because that's the only thing they can do. And you can see here the next crisis, now we are stopping with this, and the next price is 12 trillion to do whatever it takes to save the economy. However, the rates are going down, so it's clear that the economy cannot function at rates higher than 2%, and price stability will be sacrificed for maximum unemployment. That means that inflation will likely be higher in the future, especially when somebody new comes that is pro-Trump, rates at 2%, let inflation go, and that's how we solve our problems. The key is that the more the Fed uses these tools, the less effective those tools become. The more you print money, the less value there is in that money, the more you have to print. There is no real return on money. Savers get clobbered like that has to be in the last 15 years, inflation, and that's something that simply changes things. So, lowering rates while inflation hasn't been really tamed for the last 4 years. That's a big deal, which means inflation is growing and we are going to keep it at 3%, 4%, maybe sometimes at 2% where we can then again lower rates. We need to lower rates because the net interest on the 40 trillion of debt is biting the deficits. You need to have inflation at 4% to justify deficits at 7%. The rich are getting richer, the poor keep on losing. Because if you look at the wealth gap, the rich are getting richer in percentage, and the bottom 50% is struggling more and more. For now it works, employment is the key factor, and as long as people are employed, there are no issues. No issues, yes, their purchasing power is going down, but hey, I'm not Mark Zuckerberg, Jeff Bezos, that all that matters is that I get married in Venice. But unemployment is surely going up, first signs are there, ugly layoff situations. When these things don't work anymore, the outcome is inevitable, don't know when, but the collapse of the currency, as we have seen in the purchasing power deterioration over the last few years. Destroying purchasing power, inflationary collapse, debt deflation, at some point they might have to raise rates to service the debt because nobody will want low rates, debt, loss in confidence in the dollar, political anger over inequality, and the market stops reacting to policy moves. If the market goes down and the Fed says we'll buy stocks and that doesn't help, then it's over. That day is closer, getting closer day by the day, because what's going on is unsustainable. I don't know for how long the party will continue. 6 months, 5 years, 10 years, 15. I would say in the next 15 something will happen. But as rates go lower, the stock market goes higher, 20% in the past years. And as it's expected that we will have 2% rates, I would not be surprised with the stock market up 20% next 12 months. And then even whatever happens, the name of the game is the Fed will save the stock market no matter what. Because the Greenspan put was there, the Bernanke put, the Powell pivot already before the pandemic, they started to lowering rates, printing money because they saw it's not sustainable. Inflation at 3% and higher is the only solution for stability, so not to free fall and then hope that everything works well, kicking the can down the road. But the question is, will the Fed always save us? Because if you look at this, they will try to save everybody, but at some point it might not work because the market will be scared about too much inflation, too higher interest rates from the markets on the debt. The only solution is inflation. It has a cost, but perhaps is the best distributed pain solution rather than huge shocks or things like that that nobody likes. Inflation is the hidden tax that you pay but you are not wired to think about, but you're getting poorer. Now, when it comes to investing, what to do, the solution is always value investing. I think it's the only solution. It's not cool now, but it will be. Because the goal is that no matter what happens, I do well. And if I look at our value investing quadrant, the S&P now is a terrible investment. And here we have interesting positions that offer these yields between 8 and 12%. We will work through these next week in the update of the quadrant to see what is best, but there is significant value. Also, you can check my research platform where I have a list of stocks that I follow over time. You also have my portfolios that are focusing on building a value investment, let's say margin of safety, exposure that will do well no matter what happens. And then when something hits our buy levels, I buy for the portfolios. Good dividends, good growth, good assets, good protection. Feel free to check out my research platform. What kind of examples? This was more a buy towards the 40s, 50s, but it's still good because a 3.3% dividend yield, let's say we grow at 4% inflation, 3% organically, that's 7% plus 3, that's 10 to 13% return. That are still good returns. And given that this is a food business, storage of grain, procurement, oil seeds, carbohydrates, nutrition, things like that, animal nutrition, so transportation, those are hard assets that will have the benefit through inflation. Now, it is, let's say, fairly priced, but you can watch that as I do on my list and then buy when it's cheaper. The strategy is to watch businesses that have value, that are value businesses, try to get the best price, 5 to 7% yield, 5% growth, and that's a double-digit return. And that will build your wealth no matter what happens, no matter what the Fed farts. Because this is the inflation-adjusted S&P 500. After good periods, you have 30 years, 15 years of zero real returns. Only the dividends helps you. And we have been in a good period. It's likely that a 20-year zero return period could be upon us. And a current yield of 1.15% doesn't save you. A current yield of 10 to 15% or 5 to 7% dividend is what allows you to buy here, 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 and build wealth even in the times that nobody builds wealth. Check my research platform, subscribe to this channel, and we'll build wealth no matter what happens.